All right, so this is the Excel environment, and these graphs up here, these are just raw Excel graphs. You know, you can graph whatever Excel really allows you to graph. What I was more interested in is actually just getting the data into Excel, make it a little bit easier to use. So I'm going to scroll down here for a second. So you can see this large data table here is the data that I grabbed from through this LimExcel add-in. And just to give you a quick view of what it looks like. So this is the add-in built into the ribbon. Just I'm going to go ahead and open it up just so you can get an idea of what it looks like, and from there I'll just jump over and we'll get into the nitty-gritty of all these numbers down at the bottom here. Okay, so this is just a quick screenshot of the Lim add-in. As you can see, really it's quite easy to use. You got the top 2/3 of the screen here, which is really about finding the data within the database. The bottom third of the screen is where you put the data in what we call a basket. From the basket, you just send it to Excel. So I'm not going to run anything just because I don't want to overwrite the numbers that I already have. But it's simple as me double-clicking this first point right here called NYMEX Light Sweet Crude Oil. Double-click, I hit Send to Table, and it's in my spreadsheet. Just going to hop out of this, and we'll go back into the actual Excel function itself. So you can see that I essentially just repeated, or I just grabbed that process, and here is my actual function. So once you grab it from that user interface that I was just in, it actually embeds a call or an Excel function within my spreadsheet. So this is a nice feature, so I don't actually have to go back to that user interface every time I want to modify my call that I have right here, my Excel function. This operates the exact same way that like an equals average or an equals sum does in Excel. It's just, in this particular case, it's called a equals lim QR, which just stands for query refresh. And you can see I'm just referencing this big call right here that I have in the particular Excel environment, and just pulling back all this data. So you can see it's just kind of repetitive or across the top of the screen here. We're looking at, these are the ICE contracts for the on peak of 2007 to the 2011. The off peaks, I'm looking at a spread between them. As we go farther over, I have temperature, and then I have the actual prices from the ISO themselves. I'm just going to scroll up. I'm just going to explain this all through the graphs. Just know that the data's on the bottom. It's just a little bit easier to sort and view the data when it's in a graphical format. So on the left-hand side here, the red two graphs are the peak, and the blue two graphs are the off-peak. And the very left is the ICE contracts, and on the right-hand side is the daily either peak in red or off-peak in blue average. So again, this is for MISO, and this is on the Cinergy Hub in close to Cincinnati, right near the Indiana border there. And if we kind of look at this graph right here, you can see that the 2007 and 2008 year are clear front runners, trading around 65 to 70 pretty much throughout the whole entire month. And then we have 09 and 2010 down here, which are more around 40. So they're kind of the dogs of the bunch in this particular case. So you can see a big divergence here, which in itself is interesting that is trading so much higher in those particular 2 years opposed to the last 2 years, which again kind of segues into different drivers that have caused that. Off-peak, same thing, not quite as big of a discrepancy here, but again, 07 and 08, clear front runners. 09 and 2010 are trade quite a bit lower. Little blue line here that represents 2011, and the vertical line going up and down all these graphs represents where we are today. Same thing for the ISO peak and ISO off peak. So this data is actually coming directly from the Midwest ISO. Again, I'm just pulling either the peak or off peak averages, graphing that, a little bit more difficult to tell just because there's a lot more volatility as it's going throughout the day. So to help with that issue, I made little data tables, and this is where I've kind of identified if there's been a divergence or a convergence. So this first table up here is labeled prices on February 10th. So I'm looking at the OTC peak price on February 10th. So in 2007, that was $73.03. Then looking at the realized float price, and what I mean by that is just over the first 10 days of the month, what is the average peak price in this case? And it was $80.68. Same thing with the off-peak or the OTC off-peak. So again, $47.10 is what the ICE contract was trading for, and the realized float off-peak is the off-peak hours that I've got from MISO that I've averaged out for the first 10 days of the month and was trading at $28.37. The reason why I have this 2007 in a different color here is because I've identified this as a divergence. So you can see that the OTC off-peak price is trading for $47.10, but the realized float price was $28.37. So immediately that's a red flag to me in that why do people, almost you could say artificially keeping that contract at $47.10 when we're already a third of the way through the month and the realized peak is $28.37. And especially for the month of February, which is, you could argue a semi-shoulder month as temperatures start warming up towards the end of the month, that the first 10 days should be the coldest, which you would think would be a higher price than what the OTC contract is trading for. But in 2007, that's not exactly what we're seeing. And so, that kind of drew the conclusion was, I wonder what the contract settled at. So then if we go down to the next data table down here, this is prices on settlement of the OTC peak and OTC off-peak. And just note that the realized float price and the OTC peak, they are one, they equal one another because the ICE or the ICE contract is settled off of whatever, in this case, Midwest ISO posts. So that's why I don't have these other two columns or two rows in here. But specifically, if you look at 2007 in the off-peak contract, you can see it settled at $43.25. So it was just interesting to me in that there was a $19 spread here at the beginning, or the first third of the month. But yet for some reason people knew that the realized float from the ISO was almost artificial in that the price is going to come back up to $43.25. So this kind of answers my first question, like if there's a big divergence, what effect does that have on the particular settlement of the OTC contract? And as I go through these, I'll highlight in red whenever there's a divergence, what I'm calling roughly $10. Whenever this settlement is near what the contract was trading for 10 days into the month. And I guess kind of the conclusion I'm drawing here is, based on the three hubs I've selected in the three different ISOs, it doesn't matter if I'm looking at peak prices or off-peak prices because I see it in both. A divergence in these two prices doesn't really suggest that the OTC contract is going to behave differently over the next 2/3 of the month. So then, from there, I kind of step down another level. I'm like, okay, if the ISO is not, in the first 10 days of the month, is not driving this, let's take a look at what is. So, in this particular case, I brought in temperature. I brought in fuel costs, or peaker fuel, what I'm calling close of natural gas. I'm defining as the peaker fuel here. I brought in the S&P as my kind of like macro indicator. I'm using the S&P as my big macro indicator that kind of takes into account bond rates, Fed rates, GDP, general emotional sense of the economy. And that could be completely flawed, but in this particular example, that's just what I chose to use. And from here, I essentially created a ranking system because it was very hard for me to go through all these different data tables and figure out which ones lined up with one another. So what I've done at the very bottom here is I looked at OTC peak settlements and I just ranked them. In this case, 1 to 4, 2007 to 2010. The reason why you're not seeing anything in the 2011 here is we haven't had settlement on these contracts yet. It's going to occur in end of February or first couple of days of March. Then I brought in the average temperature settle, and I've rated temperature based on 1 is the coldest and 4, or in this case 5, is the warmest. The peaker fuel I've rated as 1 being the highest price of peaker fuel and 5 being the lowest price of peaker fuel, and the S&P is again rated the same way, highest to lowest, 1 to 5. So when I started analyzing this last data table down here, you can see that there's pretty much unanimous correlation between the peak settlement and the off-peak settlement, in that if, well, I guess we can just say in 2007, the peak settlement, it was as high as it's been in the last 4 years, from 2007 to 2010. Same with the off-peak. 2008 was the second highest, 2010 third highest, 2009 fourth highest. As in, the peak and the off-peak seem to follow each other fairly closely. If one, is setting kind of its the winter year of the last 4, the off-peak will follow suit then. Then I looked at temperatures down below, and I wanted to see if these were ultimately based on temperature. So I looked at, okay, 2007 had the highest traded OTC contract. It also had the coldest temperature. So one particular occurrence maybe wasn't enough, so I kept on looking at that, and I realized that throughout all the different years, the temperature is somewhat correlated, but it's not a perfect match what I would expect, meaning that the colder the temperature, the higher the electricity prices are, because the more people are going to run their heaters. So then I stepped a level lower and looked at what were the costs of the fuel that ultimately kind of sets the LMP price, the peaker fuel. In this case, I used natural gas, and I found that had almost no correlation with the particular OTC contracts. And again, the natural gas contract I chose was the February contract, which closes in like around January 28th or so. So it could have been an error on my part. I kind of assumed that they're taking the February contract gas, and generating power for the month of February with the gas they're getting delivered that month, which again could have been a complete error. Maybe I should have taken the last 6 contracts and averaged them all together, meaning that these individual generation companies are storing a small amount of gas and solely producing off the top of that. Maybe they're hedging their contracts, or they're hedging their fuel for years on end, and it has little to no effect at all, no matter how I did it. And lastly, I looked at the macro indicator, which again I'm calling the S&P, and I'm seeing that when the S&P was at its highest level, the OTC price is at its highest level. When the S&P was at its lowest level, the OTC price is at its lowest level. And for 2009, for example, when the OTC was at its lowest traded level in the last 4 years, you see that the S&P has a 5 in it. The reason why the 5 is there is because I have this extra 2011 column in here. The reason why I put that in is just so people can kind of get an idea where we are today. But if you can imagine that this 3, since there's no prices for 2011 yet in the OTC contract, this 3 is really behaving more like this 4, and this 4 is really behaving more like this 5. So you're seeing a perfect correlation between the price of the S&P on the snapshot that I took in February and the OTC contract. So the 1s, 2s, 3s, and 4s all map perfectly right on top of one another. And which is quite interesting. I couldn't really riddle that at first, so I decided that I was going to go to either PJ, or I was going to look at a couple different ISOs and see if I could see the same thing going through. So I'm going to jump back to the PowerPoint now, so we're not diving all over Excel here, and we'll wrap up the analysis and draw some conclusions.